Hey everybody, how are you doing? Welcome to another edition of the Biotech Capital Compass video podcast. This time around, we're coming to you from the great state of North Carolina in the Research Triangle Park area, where I'm visiting my mom for about 2-3 weeks. This edition of the Biotech Capital Compass, we call it Biotech's Capital Hunger Games: From Survivors to Standouts. And I think as we go through this podcast, I think you will hopefully understand why we call it the Hunger Games for biotech, especially in light of the last 3 to 5 years, really hard times that biotech has had. In today's episode, we're going to tackle the paradox that is 2025 biotech. The sector is bloodied, battered, and dare we say, finally beginning to bottom out. Always say that with both my fingers crossed on both hands, and hoping that after 4 or 5 years of some many false dawns, we're seeing hopefully a good one here in biotech. So we'll start by zooming out. Why do biotech portfolio scores and company cash positions look so bad, yet feel somehow just a little bit better than actually how they look? So after that, we'll zoom in what's actually happening in the ETF land, and how this July to August bounce might be more than just a summer mirage. And finally, we'll highlight three companies: Vertex, Akeso, and Sarepta, that reflect three very different corners of the biotech survival map: Bellwether, Breakout, and Bruised. I love the three Bs. So let's start off with the first section. We call it the biotech reality check. Let's start with two numbers. First, the Seeking Alpha portfolio score for biotech, which has hovered around 2.7, 2.9 for most of the 5 years, finally cracked above 3. I use Seeking Alpha to follow a lot of my biotech companies, large to small. Love their news alerts and their analysis. And they also generate a portfolio score where they look at a lot of variables and they roll it up into one score. And that score for my portfolio, roughly around close to 200 companies in my portfolio over the last 4 or 5 years, and the ones that go out of business sort of go away, and then there's new ones enter and whatnot. It's almost like an index of sorts. That score is actually cracked above 10 pretty reliably for the last couple of months. First time I've seen that happen in about 4 to 5 years. And this is in spite of other reports, for example, like a recent Ernst & Young report that over 1/3 of public biotechs have less than a year of cash remaining. I believe this was in biospace. So which is it? A sector finally firming, or just a slow motion train wreck? I would say my answer would be yes, because this isn't really biotech's death. This is biotech's distillation. We're watching the public markets do what nature does best: select for fitness. As companies with non-viable platforms or marginal programs exit via wind downs, take unders, or takeovers, the ones that are left standing are increasingly, survivors, like the Hunger Games, but with more CRISPR and fewer cross moves. Now, what we'd like to see is this validated somehow? Let's look at ETFs. We call this section the ETF check-in. The floor may be in. We published on this just recently, I think 7-10 days ago. Let's break down what's happening under the ETF hood. Year to date, as of early August, we're looking at the SPY, which follows the S&P 500. That's up about 10%. The XBI, which tracks more small to mid-cap companies in the biotech world, is flat. The IBB, which tracks mostly larger companies, is up about 5%. But in the last 4 weeks, the last month, the biotech sector is outperforming the broader markets. The SPY is up about 4%. The XBI is up about 5%, and the IBB is up about 7%. So what's driving this? Short version: speculative flows are creeping back in, helped by short-term technical setups and event-driven spikes. But let's not pretend everyone's buying the sector. We've analyzed this and, like I said, published on this just about 7-10 days ago. Institutions are still watching from the sidelines, citing President Trump era administration risk, FDA turmoil, and venture pullback. Still, the charts don't lie. XBI's multi-month rebound is real, even if it's fragile. The question is whether we get a true breakout or just another failed attempt. So again, what we like to point out is the ETFs and especially the public markets are possibly getting a read on the sector finally getting close to the end of its consolidation phase. And we've been writing reports on this that fundamentally, the data is still good, even though there are a lot of layoffs being happening. A lot of companies are struggling to raise cash, but the fundamentals are getting better. And now the survivors that are still around, just like the Hunger Games, these are fitter companies, and so investors have more faith investing in them. And this could be showing up in this early stage ETF data where the biotech sectors, even the small caps, are outperforming the broader markets. But let's see. I'd like to see a few more months of this, maybe a couple of quarters, before we'd like to say that biotech, the bounce might be real and more longer term. Now let's go into company deep dives. This is a sector where I still think it's really not amenable unless you're very trading oriented to buying the whole sector, unless you're also long term oriented. So either very short term oriented or long term oriented. If you've got a 1 to 3 year window, I think it's better to pick stocks if that's how you like to sort of manage your portfolio, especially the biotech exposure that you have. And there we highlight 3 companies that reflect, the biotech landscape, the current landscape, in very different ways. First, Vertex Pharmaceuticals. We call this the bellwether under pressure. Vertex is still one of biotech's best-run shops. It's dominant in its cystic fibrosis sort of core franchise. It's been launching new drugs in gene editing, Casgevy. This is a partnership with CRISPR Therapeutics, and in pain, which is a drug that's developed on its own. And this is a non-opioid drug, first of its kind ever. And this company is sitting on a fortress balance sheet. But sentiment, not so hot recently. Just in the last year, the stock is down about 17% after 3 high volume drops. There's a phase 2 pain miss with this drug called suzetrigine. Its, of course, brand name is Journavax. It's already approved in one indication. They're trying to get it approved in more chronic pain indication. Also, there was a miss in its cystic fibrosis development pipeline where they've been using mRNA therapeutics to develop a drug with their partner Moderna for a small, about 10% or less of cystic fibrosis patients that cannot manufacture a missing a protein that can be treated with other Vertex drugs. And then finally, the FDA rejecting a broad label for its non-opioid drug Journavax, which is already approved in acute pain, but Vertex is trying to generate a broader label. We mentioned in our report how Vertex is working, through these short-term sort of quote unquote misses. But none of these are death blows, and our report, talks about that. But they have rattled even long-term holders. The technicals are weak, but the fundamentals are, in our analysis, fine. Consensus still expects cystic fibrosis revenues to grow by about a third by 2030, net income to double. And then other newer products that have been launched, like Casgevy and Journavax, these drugs should pick up the slack commercially, and then also Journavax and other drugs that are in development will pick up the slack from a pipeline perspective. We detailed this in our report. So think of Vertex as a blue chip athlete that's going through a slump. They still have the track record and the potential, just a little bruised over the last few games. Would you give up on this blue chip athlete? We would not. If you're especially a long-term holder, we think you should take a look at Vertex and do your analysis there. Another company that we've been highlighting since November of last year is Akeso. We call this most recently China's contender. Other companies, biotech companies in China, have been highlighted by many. We've really been liking Akeso because we know the management team there. And then, we call it from Boston, Beijing. Akeso has quietly belonged one of 2025's best biotech stories. Since we first flagged it in late 2024, the stock has done really well. The company has launched many products in China, including 2 bispecifics, PD-L1, CTLA4, and a PD-1 VEGF bispecifics. And by the way, these bispecifics are very sophisticated antibody technology. This is something where even the United States and Europe, we've not launched that many bispecific drugs. And for a company in China to have launch 2 of its own, that's actually really good. I mean, this is on the verge of, sort of like the rocket science of biotech drug development. And Akeso has 2 of these products, among many others, that has gotten approved in China. Its PD-1 VEGF drug has been licensed to Summit Therapeutics in a multi-billion-dollar drug. And if you look at we don't, we've not looked at Summit, but I know the management team there really well. And this company, there have been speculation and rumors that have been written up on the internet where there's speculation that Summit could sign an even richer multi-billion-dollar deal with AstraZeneca for this bispecific that it originally licensed out from Akeso. So, having said that, this is a company that is cash generating, China Biotech with global ambitions. So having said that, geopolitics still does matter. Foreign ownership limits are real, but Akeso science is de-risked and the partner is validated. This isn't a speculative story anymore. It's a commercial and clinical one. And with combo trials against Keytruda, which is the Merck behemoth PD-1, 20 billion, plus sales, and it'll end up being probably the largest product in biotech, at least, in the next, over the last decade to two, in the future. Other drugs might be launched that have greater potential than Keytruda, but right now it'll probably be the largest drug by sales, probably $30 billion or more. And the Akeso products are going up against Keytruda, sort of one-on-one. And so this company, Akeso, might just be the China to global crossover worth watching, is what we've been sort of mentioning in our newsletters. Lastly, let's talk about Sarepta. We call this from tragedy to turning point. It's a company I covered at a previous job with disclosure. I know the management team very well, have a lot of respect for their science and their platform, but they've been on a roller coaster. After 3 patient deaths on its Elevidys program, this is a gene therapy for a muscular dystrophy called DMD, Duchenne's muscular dystrophy. This is a muscle wasting disease. So they've had 3 deaths, as I mentioned, and mounting regulatory scrutiny. The company was forced to pause its U.S. shipments. Part of those shipments were picked back up again for a certain portion of the DMD population recently. They faced a rejection in Europe and saw stock drop 80+% year to date. And this for a large company, over 10 billion market cap is now, between 1 to 2 billion. This is really does not happen even in biotech, which is very volatile that often. But here's the twist. The FDA just reversed course. Elevidys now is back on track for ambulatory DMD patients. And while confidence in the broader AV platform has taken a hit, this move signals regulators aren't giving up on gene therapy completely. Sarepta's near-term path is rocky. Investors' trust has been shaken. But if Elevidys can deliver, and safety issues do remain isolated, this could mark the start of a long climb back. Again, just remember the stock has lost over 80%, but really has, with this, approval for ambulatory DMD patients, is probably held on to at least 50% or more of the TAM for its gene therapy drug. So again, there's a disconnect there between how much the stock is compressed and how much of the TAM is still potentially available to the company. Having said that, I think as regulatory scrutiny, hopefully it comes down. We see the company being able to launch its drugs, in other areas, limb-girdle muscular dystrophy, and then also continue to deliver on quarters in Duchenne's muscular dystrophy, deliver good revenues and earnings, and also, pay off some debts that this company owes. This could mark, again, the start of a long-term climb back. So think of as Sarepta's biotech version of rehab. Painful, uncertain, but not without hope. So, our closing thoughts. Where does this leave us? Biotech is bruised, yes, but not broken. ETF flows are stabilizing, portfolio quality is improving, and some companies like Vertex, Akeso, and even Sarepta are providing real-time case studies in resilience, redemption, and recalibration. Love it. We're going to end with the 3 R's. Thank you for tuning in. Please like, subscribe, or leave a comment if this episode resonated. Until next time, keep your compass sharp. Biotech Capital Compass signing off from the great state of North Carolina. Take care.